Hi everyone, so it's been hammer time for silver today, but I think there's good reason to actually believe that this might actually just be getting started in terms of the real silver squeeze. So let's dive on in and take a look. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. So key points we'll just have a little run through today are really the hammer that has been hit upon silver and the real squeeze that we're now really starting to see when you actually stop worrying about the actual spot price and what the potential conclusions of this actually are. So let's take a look. So what's so important to remember here is that in this WikiLeaks cable, which I've shared with you a number of times, is that, and this direct quote also expressed, was the expectation that large volume futures dealing would create a highly volatile market. In turn, the volatile price movements would diminish the initial demand for physical holding and most likely negate long-term hoarding by US citizens. So this is a deliberate approach that we are seeing towards the manipulation of gold and silver prices, and that's really key to bear in mind when you actually think about the macroeconomic fundamentals which are likely to lead to higher gold and silver prices as far as I see it. And so this graphic shows this nicely from the TF Metals report, and we can just see where the news was actually released of the need to actually raise margins for those who were buying silver. Now, the impact of this is quite significant, okay, and this was a very significant announcement, which I think a number of those big financial institutions that we looked at yesterday used as a potential reason to actually sell some of their positions and take some profits. And of course there was the flooding in the market of paper contracts. Now, why is this significant? Let's just run through this. So CME Group raised COMEX 5000 silver futures maintenance margins by 17.9% on Monday. This is taken from Reuters. Raising the margins investors must post to trade is a familiar move by CME, the world's biggest futures and commodities centric market, when it aims to head off unusual market stress and volatility. And that stress and volatility is absolutely key here. We saw silver run up really significantly. It was up double digits at one point yesterday. And so Jamie Carrasco here says that great lesson of silver price control facade for the Reddit and silver squeeze crowd by raising margins by 20% yesterday. The COMEX has forced those holding paper contracts to sell in order to meet the margin, i.e. forced selling to create a perception. Peter Spina then goes on to say the CME is doing the silver squeeze on small traders. Raising margins may cap $30 for a bit longer, shake out some contracts for the desperate shorts. The problem now is the massive physical demand which is working its way through the system. If it doesn't ease, the price will reflect. And so this is what I just want to move on to actually focus on here, the physical issue. And so in this excellent thread of tweets, Willem Middelkoop just runs through information from the Silver Institute here. And let's break this down. I've just rewritten this to hopefully make it a little easier to follow. So the total mine production annually is estimated to be 800 million according to the Silver Institute, and multiplying that by $30 as it was yesterday gives $24 billion. The annual industrial demand is around 500 million ounces, and so that means that there's 300 million available for investment. And when you multiply that by $30, that equals $9 billion. Now, PSLV, the Sprott ETF for physical silver, added 6.4 million ounces yesterday. Multiplied by $30 equals $192 million. Based on one ETF daily, assumed daily demand at 1 billion. Now, if that's the case, and we're basing this just on the Sprott example here, that actually what you can anticipate actually taking place here is this available investable demand, the annual production of investment silver, being out of stock within the course of 9-10 days or so. So this is really, really significant in terms of the ramifications it could have for industry and of course for the paper silver market. And quite rightly, yesterday a number of you pointed out that physical premiums are really absolutely significant, and we can see this here with an American Silver Eagle, and I've also just checked eBay. I just always find it interesting just looking at second-hand rates for silver, and you can see like even these Britannias are going at what, just over £30 an ounce here, against a silver price in pounds. I'm not sure where it is in pounds right now, maybe about 19.50, maybe about £19 or so. And so this raises some really deep questions, I believe, that is what we are seeing, the start of a seminal silver crisis, with the potential of finally bringing down the manipulated paper silver market. I think there is that possibility. Can COMEX and SLV really source the physical silver required amidst such high demand? And I think once again that's a really, really important question, because they are really struggling to do so. And so very, very interesting metric that we can actually see this squeeze on physical silver is the implied silver lease rates. So this is when silver is leased and then is used as a fractional reserve silver basis to generate somewhere between 250 to 500 paper contracts. But just look at the spike that we actually see take place in terms of the actual leasing costs. They really do rise dramatically. Now, what that obviously suggests is that there is a real shortage in terms of the physical supply that is actually available there. So that's highly significant, and I think that is well worth keeping an eye on these lease rates, because it really does tell us a lot about what is really going on. And when we compare that with the situation in gold, we don't see any such spike in the gold lease rates at all. It's very interesting. The tightness within the market is clearly within silver, and while we're seeing the spot prices being hammered, the actual physical availability of silver is clearly very, very constrained. And just to emphasize this, there's a post on Reddit, Wall Street Silver, which is just about cleaning the silver from the market. Now keep the market dry for a month and we'll win. So interesting take. But I think what's really interesting about this is this point down at the bottom that whoever this is suggests they have quite a good feeling that many mining CEOs are supporting our efforts to squeeze the market and will quietly withdraw new supply. They may supply just what they have already sold up front and what needs to be sold to cover costs, but nothing more. And so what conclusions can we draw? Well, there's clearly a real problem in terms of sourcing physical silver right now, and I think that's massively significant. What does it mean for the actual price, the spot price? Well, short term, it's almost impossible to tell with the way in which these markets have been hammered and the way in which they're manipulated. Longer term, it comes down to that ability to actually source that physical silver. And in terms of industrial demand, I can see industrial demand growing certainly over the next few years as we see these Green New Deals rolled out. What's more, I think investment demand is likely to pick up as well. And so while we might see the actual spot price soften perhaps, then I don't think that is any such indication of the actual fundamentals and the real supply-demand issues that are actually apparent within the marketplace. What do you think? I'd love to hear your thoughts on this, so do let me know in the comments below. Thanks so much for watching. Do consider subscribing, and I look forward to seeing you next time. Bye bye.